Municipal bond investors have been generally more downbeat about the asset class recently, as downside risks to the domestic and global economy have been largely overshadowed by optimism about U.S. China trade talks, as well as widespread expectations that the Federal Reserve will cut rates at its coming meeting. The specter of a so-called Phase 1 trade deal, a partial resolution to the ongoing trade conflict, seems to have eclipsed more fundamental concerns about slowing global growth amid deteriorating manufacturing conditions, faltering business expectations, and other economic uncertainties. These have been highlighted by disappointing earnings results from the likes of equipment maker Caterpillar and semiconductor giant Texas Instruments. Even while prices of U.S. Treasuries have risen somewhat, tax-exempt municipal bonds have softened, with many market participants generally rotating out of fixed income and into stocks. However, Nuveen analysts Bill Martin and John Miller said that despite the sell-off, they continue to think munis remain an attractive investment opportunity. This as investors will likely take advantage of higher yields and a higher new issue calendar through the end of the year amid rates that will stay lower for longer. Indeed, the market's implied probability the FOMC will elect to cut interest rates by another 25 basis points at the conclusion to its two-day monetary policy meeting on October 30th has risen to more than 90%, especially after Fed Vice Chair Richard Clarida highlighted that business fixed investment has slowed notably since last year, exports are contracting on a year-over-year basis, and indicators of manufacturing activity are weakening. The FOMC at both its July and September meetings voted to lower the target range for the federal funds rate by 25 basis points to what is now 1.75% to 2%. Meanwhile, demand for municipal bonds does remain healthy, underscored by 41 straight weeks of fund inflows and an active primary market that has seen a recent rise in taxable supply. Broward County, Florida, for example, is on tap to sell around $430 million of both tax-free and taxable water and sewer utility revenue and revenue refunding bonds. The county intends to peg the proceeds from the issuance in large part to fund various water and sewer projects, as well as to help refund existing municipal debt. Broward County has a 5-year capital program in place with a budget about on par to meet its plan and expects to finance around 60% of the program with debt and the remainder with cash on hand. Moody's analyst Valentina Gomez noted that the agency's credit rating reflects stable coverage levels, healthy liquidity, a large and diverse customer base, and about above average debt burden. She also said that the rating is further supported by wholesale customers, which pay close to 40% of debt service post-issuance based on reserved capacity. The offering, which is being lead managed by Bank of America Merrill Lynch, is slated to be sold in the week of November 5th. In the meantime, select the event calendar option in the IBKR Trader workstation for a full list of U.S. and global corporate events and earnings, dividend schedules, economic data, IPOs, and more. I'm Steven Levine for Interactive Brokers.